The first stock that I want to discuss is Brookfield Corporation with the ticker symbol BN. Now, if you've been watching my channel for some time, then this is probably going to be absolutely no surprise to you because I talk about Brookfield a lot and it is the largest position in my portfolio. But heading into 2026, even though the stock is selling right near all-time highs and it's actually up another 4% on the day today, this stock is still undervalued in my opinion, and I am adding to my position pretty much all of the time to keep it around 25% of my overall portfolio. The reason that I remain bullish on Brookfield Corporation is because while many companies are investing in software and artificial intelligence, Brookfield invests and owns real physical assets that the global economy needs to run smoothly. They own things like skyscrapers, hydroelectric dams, nuclear power plants, pipelines, data centers, toll roads, railroads, and the list goes on and on and on. Now, the reason Brookfield Corporation remains the largest position in my portfolio is because I feel extremely confident that the globe is going to need a lot more infrastructure to continue growing and pursuing technological advancements. And I think that Brookfield is one of the best positioned companies to benefit from all of this. So let's now dive deeper into Brookfield Corporation, and I want to share some of their recent investor material that they have put out. This first screenshot shows that Brookfield Corporation is the parent company of many different subsidiaries, many of which are publicly traded. These subsidiaries are Brookfield Asset Management, Wealth Solutions, and all of the operating businesses like Brookfield Infrastructure and Brookfield Renewable Partners. The organization is quite complex and it does take some time to understand. So this DCF is pricing in no multiple expansion and a slight miss to their compounded annual growth rate of 25%. And despite this, we still get a compounded annual growth rate to the share price of roughly 22% and a fair value of $77.76 US, which is 67% above where the stock is currently trading. All right, now the third stock that I want to discuss in this video is CP Rail. CP is one of the two railroads that operate across Canada, which makes it a duopoly with CN Rail. However, CP also has access to the United States and Mexican economies, and it acquired its Mexican extension from Kansas City Southern, which was a pretty contested acquisition because CN Rail was also trying to acquire Kansas City. But by CP acquiring Kansas City and getting that extension down into Mexico, it has made CP the only rail network that extends from Canada all the way down into Mexico, and I think that this gives CP a massive competitive advantage. It is the only rail network that connects Canada, the United States, and Mexico, and I think this arguably makes it the most valuable rail network in the world. For goods to move from Mexico to Canada on any other rail network, it will require switching trains. This means that CP offers a faster, cheaper, and more reliable service than any other rail or trucking option. Again, this gives the company an edge over all of its competitors. You also cannot build a new cross-continental railroad today. The land rights and environmental permits will make it impossible. This means that CP owns a bottleneck on North American trade that literally cannot be replicated. I believe that railroads as a whole have some of the strongest and most durable long-term moats. And as long as goods need to move from one area of the economy to another area, they will have business and continue producing cash flow for their shareholders. I feel almost certain that the existing railroads in North America will be producing cash flows and doing business 100 years from now. That is how critical they are to our economy. This is because a single train keeps approximately 300 trucks off the road. Like, just imagine having to move all of the goods that trains carry onto our existing roadways. This would be an absolute nightmare and would also be dangerous for everyone on the road. Additionally, trains are 3 to 4 times more fuel efficient than trucks, which ultimately means that trains are far more efficient, safer, and cleaner. But getting back to CP's competitive advantages and growth drivers, here we can see that Mexican imports into the US have been growing significantly and consistently. The US had $506 billion worth of imports from Mexico in 2024, and again, it's clearly uptrending. The total value of goods traded between Mexico and the United States was $840 billion in 2024. In 2024, Mexico was also the largest importer of goods into the United States, even above China. So owning a railroad that transports these goods, I think, is very valuable. CP is expecting high single-digit revenue growth, but double-digit core adjusted earnings per share growth. This is because the company wants its capex and expenses to remain flat while the revenue continues to grow, which ultimately means that its profit margins are projected to continue expanding. And as of the third quarter, we saw this exact thing happening. CP's revenue grew by 3%, but its earnings per share grew by 11%, which was also partly because the share count declined by 3% over the past year. Revenue is currently seeing some headwinds, but the business is still growing and its profits are growing quite well. If we head over to Stock Unlock and compare CP versus some of its main competitors like Union Pacific and Canadian National Railroad, and we look at the diluted earnings per share growth since 2011 here, then here we can see that CP's earnings per share is up 630% versus UNP's 294% and CN Rail's 200%. So since 2011, CP has grown its earnings the most by far. However, if we take a look at the price to earnings ratios of all of these businesses today, we can see that CP is trading for a slight premium of 21.6 times earnings, UNP is at 19.7, and CN is at 18.4. So CP's price does factor in a little bit more growth and potentially the higher quality rail network that the business owns. Now, lastly, I did a quick discounted cash flow calculation on CP, and I'm saying that its earnings will continue to grow by 11% annually over the next 5 years. They'll continue to buy back roughly 3% of their shares and trade for a 20 price to earnings ratio, which is slight multiple compression from where the stock is currently trading. In this DCF, the compounded annual growth rate to the share price would be 13.5%, and the fair value of the stock would be $85 US, which is roughly 17% above where the stock is currently trading. Now, railroads are not the sexiest or highest growth investments, but I do think that they can act like anchors in a portfolio because, as I said earlier, I believe that these businesses have some of the strongest moats that I've ever seen. And I do believe that they will be producing cash flows 100 years from now. So in terms of the reliability and durability of business models, I think there's almost nothing better than a railroad. And again, that's why I say that they can act like anchors in a portfolio. And CP, in my opinion, is looking slightly undervalued here because the stock has been flat for roughly 4 years now, as the underlying fundamentals of the business have continued to grow, which have resulted in multiple compression down to a point where I think CP is now undervalued. It's not massively undervalued, but I do think that it is below fair value now. But full disclosure, I do not own any CP in my own portfolio because it is not the type of investment that I am looking for as a younger person. I like to have more growth potential in my own portfolio, and I'm not really looking for those anchors right now. So CP is not a stock that I own. It is on my radar in case it continues to get cheaper, but I do think that it is looking compelling at its current price, and it is worth putting on your radar as well. All right, let's now move on to the fourth stock that I want to discuss in this video, and it only feels right to make the fourth stock 4, which is Shift4 Payments. This is a stock that I have previously talked about on my channel, but the share price has continued to come down and show weakness, while the fundamentals, in my opinion, have only continued to grow. So I want to update you on Shift4 and explain why I think it could be an outperformer in 2026. Shift4 is a one-stop shop that provides software and hardware to help businesses operate and accept payments. They specialize in offering software and payment solutions to the hospitality and entertainment industries, but they are expanding beyond them as well and also expanding internationally. Shift4 software is specifically designed to handle everything restaurants and hotels need. They have curbside ordering, menu configuration, inventory tracking, loyalty programs, QR menus and ordering, wait lists and reservations, table management, and so much more. They often give their software away for free or for a very low cost to land a new merchant. Then they make their money on the billions of dollars in transaction volumes that flow through their systems. In their most recent investor update, they shared a slide on what a venue looks like without the Shift4 system. Here you can see that merchants must combine multiple systems and complexities to operate their businesses. Then they provide a slide on what a venue looks like when they have the Shift4 system. And here you can see that Shift4 provides everything that this venue needs, which means that the venue can work with a single vendor, which is Shift4, for everything that their business needs to operate. Now, in my view, Shift4 is like a vertical market software business that generates its revenue through the transaction volumes of its customers. This is why this business interests me, and why I think that it has an advantage over pure play payments businesses that don't also offer software solutions. Shift4 is also a serial acquirer, and just completed its largest acquisition ever of Global Blue for $2.5 billion. Global Blue is said to be the undisputed king of tax-free shopping, which is like processing VAT refunds for tourists. Global Blue's customers aren't just local vendors or small vendors, though. They are typically iconic luxury brands like Louis Vuitton, Prada, and Hermes. Global Blue has a total customer base of over 75,000 luxury and non luxury retailers with over 400,000 locations and over 15 million shoppers worldwide. Shift4 is using the Global Blue acquisition as a launchpad for a massive land and expand strategy. They are buying the customer relationships with the world's most elite retailers. And then again, they want to use their land and expand strategy. Shift4's goal is to convince these global luxury merchants to switch their entire payments processing to Shift4's platforms over time. This acquisition opened up a new vertical for Shift4 as well, and diversified its revenue more into Europe. One of Shift4's main plans is to continue their global expansion, and Global Blue is helping them do so. Now, if we take a look at their most recent quarter performance, we can see that total transaction volume is up 26% year over year. Revenue was up 29%, gross profit was up 62%, gross revenue was up 61%, and operating and free cash flow were up 21% and 27% respectively. So Shift4 is growing every single metric by over 20% year over year. The business is also projecting high teens organic growth.
You like Apple. What is it about Apple now? Because there was all this talk about the super cycle. When was it going to come? It does seem like it came last year with the 17, but where do you see it now? And what's the catalyst from here to drive further growth?
Well, I think to some degree, because they've been so pitiful in AI, that's the catalyst to drive growth. Because, the stock was only up 9% last year. They've had, and before that last year, they had a combined growth of 1% over the prior 3 years before that of revenue growth, which is absolutely pitiful. And so if you look at what's coming, though, at the end of this year, you're going to get a AI-enabled Siri on a foldable phone that's going to come for this upcoming Christmas cycle. And if you go back through time, the biggest upgrade cycles have happened around form factor changes when you get a bigger screen. So if you look at the iPhone 6, for example, when you went from a 4-inch screen to a 5.5-inch screen, revenue growth went from 7% in fiscal 14 to 28% growth in fiscal 15. And so that's why I think as you get closer towards the end of this year, people start getting excited and go, finally, I get an AI on my Apple device. And in addition to that, I get a foldable phone, which, by the way, Samsung has had one since 2019. Well, the reason I picked it for last year, so a year ago when I gave the thesis, it was, look, I think they're going to show that they're a credible player in AI. And Cisco's revenue growth for the prior 5 years before last year was 1% per year on average for 5 years. So that's about as bad as you can get. Last year, that growth for fiscal 25 accelerated to about 5%. This year, I think it can accelerate to the high single digits. But when you look at the multiple, you go, wow, it's only trading at a high teens PE, where the S&P is trading at 22 times forward. And so if you think infrastructure revenues related to AI go from about $1 billion last year to closer to $3 billion this year, I think that continues to get people interested, because from a big picture basis, you're generating all this AI data. Well, corporations need to get access to that, and so they're going to need to upgrade their networks. And the last big upgrade happened during COVID. That was about 5-6 years ago. And so it's about time also for an upgrade cycle for enterprise, and so those two things are hitting simultaneously.
Okay, let's talk about another one on your list. This is outside of the AI space. This one's Boeing. I love big backlogs, and I cannot lie. I like that, how you characterize that, the call out to Sir Mix-a-Lot. Tell us about how you see Boeing this year. It had a very different year last year from the prior year. I'm sure some investors were breathing a sigh of relief after several years of pain for Boeing. Where do you see it going this year?
Well, I think, number one, congratulations for recognizing where that phrase comes from. But if you look at Boeing, The big difference is in September of this last year. Remember, they had that horrific crash in 2019, and so they've been under massive regulatory oversight. September of this past year, they had limited authority to start self-certifying their planes. And so now you can really start to crank up the shipments of these planes. And they had negative $2 billion in cash flow in calendar 25. I think that improves to low single-digit billions of positive cash flow in calendar 26, and that should grow to close to 10 billion before the end of this decade. And that's not a hard bar to clear because they were doing about 14 billion in calendar 18. So I think with that momentum really picking up, that's going to help Boeing continue to re-rate. It's already had a great start to this year, and I think it's going to continue to gain momentum. And let's not forget, a quick way for any country to fix a trade deficit problem with the US is to buy Boeing airplanes because they're so expensive. And you've seen that with a lot of the trade deals. So that's an extra kicker on the side. And obviously they do defense as well. And clearly the geopolitical climate has gotten a lot more interesting, let's say, over this last few weeks.
All right, let's talk Nike. It's on your list. This is the one I knew your list obviously ahead of time. This is one I have questions about. Elliott Hill's working on a turnaround there, obviously. But if you bought this stock 10 years ago, if you go back to 2016, 2015, you're not super happy with how it's performed. How long before you lose patience, and why do you like it here for this year?
Well, let's be clear. I liked it for this year. I didn't like it last year. So
okay.
There's a couple of different things. So the first thing with a turnaround is you go, is there something fundamentally wrong with the company? And if you look at the brand globally, it was the 10th ranked brand in the world at one point. And when they brought in the old CEO, he was from eBay. And he changed the strategy. And he said, look, I'm from eBay. I want to take the company more to a direct model. It was the wrong thing to do, and you saw the global brand drop from about 10 into the high 20s. Elliott Hill came in about a year ago. He's a 32-year Nike veteran. He started as an intern at Nike. He said, look, we're going back to the basics, and our basics were we were focused on sports, we were focused on having a strong retail presence, and that's what we're going to get back to, and innovation of our products. And if you look at what's happened now that he's been a year into the job, in the US, 2 quarters ago, revenues were down about 11% year over year. This most recent quarter, they were up 9%. So it's already starting to take effect in North America where things are changing. I think you're going to next see a turnaround in Europe. And then I think China is the hardest market for them. That'll be last on the list. But where's the valuation? Well, everybody, to your point, has looked at this and gone, the stock's where it was a decade ago. Why would I own this thing? And that's why the enterprise value to sales number is at the lowest point in a decade, excluding the tariff-driven drop that we saw, earlier last year. And so you're getting a very good brand with a credible way to turn it around where you've already got some evidence in North America that it's working at a low multiple. That's what you want to have. And in some ways, it's my Cisco pick for this year, and that this is exactly how Cisco looked a year ago, where rightly it had been given up for dead, just given how poor its growth had been over the prior 5 years.
Yeah, I mean, I hear what you're saying, part turnaround, part valuation story here. And listen, my heart certainly roots for Nike because, listen, I came up with Nike. But it's hard to see, especially even when you do the kind of sentiment test or you see what people are wearing. But I don't want to count them out. I remember the Just Do It. It's the Michael Jordan name. We'll see if this is a comeback story this year. Let's talk